Hello, everybody. My name is Bianca Beck. I am the Middle East Marketing Manager for Sovereign PPG. Thank you so much for joining us today. I just want to say a couple of house rules. The session is being recorded, and we will be able to share the recording and presentation with you after the session. Today's webinar is led by our Senior Client Accounting Manager at Sovereign PPG UAE, Mr. Ali Nawaz. And he is going to take us through how to prepare for your business's first UAE corporate tax return. So Ali, I will hand over to you.
All right. Thank you, Bianca. Hi, everyone. Thank you for joining this webinar. In today's session, I'll give you an overview of the UAE corporate tax, including details of taxable persons, qualifying free zone persons, taxability of natural persons. I'll show you how to calculate taxable income, information about reliefs available for small businesses, and some key deadlines and related penalties. Before 2018, generally there were no taxes in UAE except for oil and gas sector and some banks, and life was much simpler for corporations. Since then, things have changed a lot. VAT was introduced from 1st of Jan 2018, and it carried some compliance obligations for the companies. But not all companies were within the scope of VAT, only those that carried out taxable transactions and that reached the threshold. Corporate tax, however, is a different story and is applicable on every UAE company. Whenever corporate tax gets introduced in a jurisdiction, government becomes a key stakeholder in corporations. This is the reason corporate tax carries much more compliance obligations than VAT or any other kind of tax. Like all other countries, UAE has also included penalties in corporate tax regulations. So companies that do not meet their obligations will be subject to these penalties. We'll discuss penalties in detail in the coming slides. Proper planning is needed so you can optimize your tax liability and pay as less of a tax as is legally allowed. The first step of this would be to carry out a detailed corporate tax assessment to see where you stand and what you need to change in your current processes to achieve compliance. You also need to educate yourself about deductions that are allowed and those that are not allowed. The different reliefs that you can take advantage of, for example, small business relief, uh, qualifying group relief, brought forward losses, participation exemption, etc. It is also important to mention here that with the introduction of corporate tax, importance of proper bookkeeping has increased many folds. It is of utmost importance that your books are well maintained as per regulations. Transactions are clearly categorized into different categories, as that would make life much easier when you are in the process of filing the corporate tax return. You need to ask yourself, can I extract details of all my financial transactions? Do I know how much is the taxable income? How much are the deductible expenses and which expenses are not allowed as per corporate tax? How much dividend did my company earn from its local holdings and how much dividend did it earn from foreign companies? Does dividend earned from foreign holdings satisfy the conditions of participation exemption or not? Uh, are you a free zone company? Do you know if you can claim the 0% regime? Just being established in a free zone does not mean you'll automatically get the 0% rate for corporate tax. Next slide, please. Okay, so these are all the areas that I'll try to cover in today's session. Next slide, please. Corporate tax regulations came out in 2022 and are effective from 1st of June 2023. The standard rate is 9% for companies, which is still less than most of the jurisdictions around the world. Compare that rate with other countries like Qatar, where corporate tax rate is 10%, Oman, where it is 15%, Saudi, where it is 20%, and Kuwait, where it is 15%. So UAE corporate tax is still much lower than the neighboring countries. UAE has introduced a threshold for very small businesses. So if your taxable income is less than 375,000 dirham in any given tax year, you don't pay any tax. This is applicable for all UAE companies except for qualifying free zone companies. This does not mean that you don't need to register. You still need to register and file your corporate tax returns annually. Free zone companies can avail the 0% tax regime, but we'll discuss this in detail in the coming slides. UAE has also introduced a domestic minimum top-up tax. It's a 15% tax where they'll tax multinational enterprises who have a consolidated revenue of 750 million euros or more. This is in line with Pillar 2, and other countries have also started implementing this. For example, Bahrain and Kuwait, they recently implemented this TMTT. To reduce the compliance burden for companies, UAE has not set a separate tax year, as is the case in many other countries. Instead, it has made the tax year same as the financial year. So if you have a financial year of Jan to December, then this is your tax year as well. Although corporate tax got implemented from 1st of June 2023, but your first year tax year depends on your financial year. For example, if you have a financial year of June to May, then your first tax year is 1st of June 2023 to 31st of May 2024. And you need to file your corporate tax return before end of this month, before end of Feb 2025. Similarly, if you have a financial year of Jan to December, then your first tax year is Jan to December 2024, and you have until end of September 2025 to file and pay your corporate tax. Next slide, please. Okay, so who is a taxable person? A taxable person could be a resident person or a non-resident person. A non-resident person becomes a taxable person when either they have a permanent establishment in UAE or they derive state-sourced income, or they have nexus in UAE, for example, property from which they are earning income. For resident persons, it could be a legal person like a mainland company or a free zone company, or it could be a national person if they conduct a business activity of more than 1 million dirhams. Foreign companies can also be considered as resident and taxable if they are effectively managed and controlled from within UAE. For example, there's a BVI company, let's say, the UBO, the shareholder, and the director, it's the same person, and they live in UAE and take all decisions from UAE. This entity will be considered as resident in UAE and will therefore be within the purview of UAE corporate tax. Next slide, please. UAE corporate tax regulations have given exemptions to some entities for various reasons. For example, they have exempted government entities and government-controlled entities as long as they do the same work as the government parent entities and are not engaged in any commercial activity in competition with the private sector. They have exempted companies engaged in extractive or non-extractive businesses of natural resources. This sector has always been subject to local emirate level taxation and are already paying high levels of taxation to the emirates where they operate. So it makes sense to exempt them. They've also exempted qualifying public benefit entities and that do good for the general public. Uh, all the qualifying public benefit entities are listed in Cabinet Decision number 37 of 2023. All these entities are automatically exempt from corporate tax, so they don't actually need to register for corporate tax or even file an application to claim exemption. On the other hand, entities like qualifying investment funds or public or private pensions and entities controlled by exempt persons, they need to file an application for exemption. Only after the approval of this application, they'll be considered exempt from corporate tax. Next slide, please. How does corporate tax work for natural persons? If you are a natural person and you conduct a business activity in UAE and the turnover from this business activity is more than 1 million dirhams, then you need to register for corporate tax and file corporate tax returns. Um, it is important to note that business or business activity does not include personal investments like investment in stock exchange or companies, employment income like salary or bonus or commission, income from real estate, whether it is income from sale or leasing of the property. For example, if you're a national person and you're working for a company and earning employment income of, let's say, 1 million dirham a year, and you have bought a property in UAE which you are renting out and earning 200,000 dirham per year. At the same time, you are providing consulting services to a few clients and you earn 500,000 dirham from this activity per year. From the perspective of UAE corporate tax, employment income and real estate income will be ignored. Since you are earning 500,000 from your business activity, you are below the threshold. And therefore, you do not need to register or pay any corporate tax on this. Next slide, please. Okay, time for a quick poll. Bianca, can you release the poll? You'll not see it on the screen. Please, we urge you to participate in it. We'll just give 2 minutes for everyone to take part. The question is, have you registered for UAE Corporate Tax and received a corporate tax certificate? We'll just give 2 minutes for everyone to participate.
Oh, Ali,
54% people said that they have registered and received a corporate tax certificate. 28% said no. At this time, this is an alarming figure if 28% people have not registered, because the last deadline was end of December. So please, if you have not registered, if you need help registering, please reach out to us and we'll assist you with this. Next slide, please. Sorry, can you go back? Who needs to register for UAE corporate tax? If you have a company in UAE, whether in mainland or free zone, you need to register. If you are a foreign company, but being effectively managed from UAE, you need to register. If you are a natural person who is conducting business activity in excess of 1 million dirham, you need to register. If you are a non-resident person with either a permanent establishment in UAE or is earning state-sourced income, you need to register. One of the examples of state-sourced income would be if a Singaporean company owns a property in UAE and is renting it out to earn income. This Singaporean company would be considered as earning state-sourced income and would be required to register for corporate tax. Another example would be if a UK-based consulting firm sends a team to UAE to deliver an on-site project for a local client and it takes several months. Since the services are physically performed in UAE, it would create a potential permanent establishment or at least state-sourced income, and the UK company would be required to register for corporate tax. Next slide, please. In this slide, we'll discuss about which expenses are allowed for corporate tax and which are not allowed. As a general rule, any expense incurred for business purposes and that helps in generating taxable income is an allowed or deductible expense. All business expenses are allowed other than those of capital nature. Now, why is capital expenditure not allowed? This is because capital expenses are not expensed out. but rather they go on the balance sheet as an asset of the company. And every month, a depreciation charge goes into expenses. This depreciation expense, if it is aligned with IFRS and tax depreciation rates, it will be a deductible expense. The net interest expense, meaning the total interest expense minus the total interest income. If it is less than 12 million dirhams, then it is fully allowed. However, if it is more than 12 million dirhams, then it is restricted to 30% of EBITDA. EBITDA is the company's earnings before interest, tax, depreciation, and amortization. If we talk about entertainment expenditure, it is capped at 50% if it is for client entertainment. However, for employees' entertainment, this is fully allowed, 100%. Irrecoverable VAT. If for any reason you are unable to claim input VAT on any of your purchases, maybe it is related to your exempt income, it goes into the P&L as an expense, and it is an allowed deduction for corporate tax. Similarly, any expenses related to connected persons will be allowed only if they correspond to market value and are aligned with transfer pricing regulations. Non-deductible expenses. Any non-business expense, for example, personal expenses, they are not allowed. Any expenses that are related to exempt income are not allowed. Donations. Okay, so donations are allowed only to qualifying public benefit entities that are on the list issued by the ministry. If you make donations to any other entity that is not on the list, it will not be allowed as a deductible expense. Uh, any fines, penalties, or illicit payments like bribes are not allowed. Corporate tax, VAT, excise tax, these are not allowable expenses. Next slide, please. Calculation of taxable income. So the start of calculation is always the accounting profit or the net profit. This is our starting point. We add back all the non-deductible expenses. It is therefore important that we clearly categorize non-deductible expenses in a separate account in P&L, so we don't have any issues when we need to adjust them. We deduct all exempt incomes like dividend income from local holdings, dividend income from foreign holdings, as long as they satisfy the participation exemption criteria. Then we adjust the tax depreciation and accounting depreciation. And finally, we take into account any brought forward tax losses from previous year. Here, it is important to note that since this is the first tax year for most companies, any losses made prior to the start of your first tax year are not allowed to be deducted, since those are only accounting losses and not tax losses. Any losses suffered after the start of your tax year will be allowed to be carried forward indefinitely and adjusted with future taxable income. There is a limit though. Only 75% of future taxable income can be adjusted with the carried forward losses. The rest will be carried forward in future years. After doing all these adjustments, we arrive at the taxable income for corporate tax purposes. Next slide, please. Okay, so this is an example of the calculation. We have a company, UAE-based company who is engaged in trading activities. They have multiple subsidiaries, including a wholly owned subsidiary in the UK. They have generated a net profit of 2 million dirhams. So if we see this is the net profit, this is the starting point for us. And then we take this, we do all the adjustments. We add back all the non-deductible expenses. We deduct all the exempt income. We then add back the disallowed accounting depreciation and deduct the allowable tax depreciation. In this example, we have considered that maybe this is the second or third tax year and they have brought forward losses of 500,000 dirham. Since these are well within the limit, the whole 500,000 would be allowed to be deducted. And finally, we have 1.38 million as the final taxable income. The 9% corporate tax will be based on this figure. Next slide, please. Okay, qualifying free zone person. There are a lot of misconceptions around this topic. The most common one being that if you have established a company in free zone, you are automatically exempt from any corporate tax, which is just plain wrong. There are a lot of conditions to satisfy before a free zone company can claim the 0% corporate tax regime. First condition is that the company does not elect to be subject to tax at 9%. This may seem strange, but for some companies who know that they won't satisfy any conditions, will elect to be subject to 9% corporate tax so they can avail different reliefs. For example, if the revenue is less than 3 million and they know that they won't be able to justify substance or any other conditions, they'll elect for 9% corporate tax and just claim small business relief and don't pay any tax. The other condition is complying with transfer pricing regulations. Complying with transfer pricing regulations means that all transactions with related parties and connected persons should be at an arm's length. We'll discuss more on this in the next few slides. Another condition is that the free zone company must maintain audited financial statements. There are no thresholds for this condition. Any free zone person that wants to avail the 0% regime must prepare and maintain audited financial statements. Free zone company, another condition is free zone company must have adequate substance. At this point, you all must have heard that the Ministry of Finance has cancelled the economic substance regulations and the related obligations of notification filing, reporting, and meeting substance. Does it mean the end of ESR in substance? No, it doesn't, because any free zone company that wants to avail the 0% regime must prove substance. This includes having office space in a free zone, adequate and qualified employees in free zone, adequate expenditure, adequate assets, and the company must be directed and managed from UAE. In the ESR regulations, if you wanted to prove substance, employees could be based anywhere in UAE. However, free zone companies wanting to prove substance, employees must be based in a free zone. If the company wants to outsource this requirement, the outsource provider must also be based in a free zone. The other condition is the free zone company must derive qualifying income. We'll discuss on which activities are considered qualifying, which are excluded, but essentially all transactions with other free zones are considered qualifying, except when it is specifically excluded. Another condition is that the company must meet de minimis requirements. Free zone companies are allowed to do transactions with mainland companies or outside UAE as long as they meet the de minimis requirement. It means that the non-qualifying income of the business cannot exceed 5% of the total revenue or 5 million dirham, whichever is lower. Next slide, please. This flowchart essentially shows that only qualifying income of a free zone person can be taxed at 0% or non-qualifying income as long as it meets the de minimis threshold. If non-qualifying income does not meet the de minimis threshold, the free zone person will lose the benefit of 0% tax for the current year and the next 4 tax years. Here, it is important to mention that a foreign entity which is effectively managed from UAE cannot be a qualifying free zone person, even if it is managed from a free zone. Next slide, please. On the screen, you'll see a list of qualifying activities segregated by goods and services. It is worth noting that if you are a distributor of goods or are in the business of high sea sales, then those can only be done via designated zone for them to be considered a qualifying activity. Designated zone concept is the same as VAT. Essentially, for a free zone to be considered as a designated zone, there are a lot of conditions like it needs to be fenced, should be a special area where movement can be controlled. Examples would be Double Ali free zone, Dubai airport free zone, etc. You'll also see the full list of excluded activities on the screen. If you only conduct business with natural persons, then you cannot claim the 0% tax regime, even if the natural person is based in a free zone. Next slide, please. All income earned from other free zone persons is qualifying income, except excluded activities. For example, as I mentioned before, transactions with natural persons is an excluded activity. And even if the natural person is based in a free zone, that transaction will be taxed at 9%. If your source of income is a non-free zone person, then you can avail the 0% regime for both qualifying activities and non-qualifying activities as long as they meet the de minimis threshold. If you perform excluded activities, whether the source of income is free zone or non-free zone, it will lead to a loss of qualifying free zone status if de minimis is not met. Next slide, please. Okay, we have the final poll for the session. Bianca, can you release it? You'll now see it on the screen. The question is, have you carried out an assessment to determine taxability for your company? Please give us your responses. We'll wait a couple of minutes for everyone to complete their poll. Okay, so the results are out. 40% people have carried out an assessment, and around 60% have not yet carried out any assessment. I, I sincerely urge you to take action today and do not leave it for closer to the deadline. Tax assessments are quite complex and they take a lot of time. So if you leave it for September and don't make it on time, you will be subject to penalties. Okay. Next slide, please. Transfer pricing. Transactions with your related parties and connected persons must be at an arm's length. It essentially means that transactions should be done on market prices. There are various thresholds related to transfer pricing that you need to be aware of. First is the threshold to prepare master and local file. If you are part of a multinational company that has a consolidated revenue of 3.15 billion dirhams or more, then you need to prepare and maintain local and master file. Similarly, if your own revenue is 200 million dirhams or more in a tax period, then you need to maintain both local and master files. Second is the related party schedule threshold. If your aggregate value of all transactions with related parties exceed 40 million dirhams in a tax year, then related party schedule needs to be prepared. Third is the connected person schedule. If the total value of transactions with connected persons in a tax year exceed 500,000 dirhams, then connected person schedule needs to be prepared. It is important to mention here that these thresholds do not exempt you from the requirements of transfer pricing. So even if you are below the threshold, you need to comply with the transfer pricing regulations and ensure that all your related party or connected person transactions are done at an arm's length basis. Next slide, please. Okay. Who are related parties? Simply put, these are parties that have a relation with your company. For example, if you own 50% or more of another company, then the other company is a related party for your company. Up to fourth degree of kinship falls under the purview of related parties, which means your parents, siblings, spouse, children, grandparents, uncles or aunts, and even cousins, they are related parties. If two entities are under common ownership or control, they are related parties. Similarly, partners in an unincorporated partnership are considered related parties. Next slide, please. Okay, Who are connected persons? These are entities or people who have close ties to a taxable person. For example, a natural person who directly or indirectly owns an ownership interest or controls the taxable person, a director or officer of the taxable person. Similar to related parties, relatives up to fourth degree of kinship are also considered connected persons, and related parties of all of these. Next slide, please. Okay, participation exemption. Uh, a UAE company earning dividend income from its local holdings is fully exempt from UAE corporate tax. However, dividend income from foreign holdings is not automatically exempt. It can be exempt if conditions of participation exemption are met. There are different conditions, like the parent company must hold at least 5% ownership interest in its foreign holdings. This condition is also satisfied if the acquisition cost is 4 million dirhams or more, even if this doesn't represent 5% ownership. The parent company must hold shares for at least 12 months or at least have the intention to hold shares for the next 12 months. Uh, the foreign company must be subject to tax at a rate of 9% or more. So if your foreign company is established in a country where there is no tax, like Cayman Islands, BVI, Bahamas, Barbados, etc., then you cannot claim this participation exemption. The reason for giving this exemption is so the profits of a company are not taxed twice, once in the country where it is incorporated and then again in the UAE. This is common in other countries of the world as well who offer similar exemptions for dividends. Next slide, please. Okay, small business relief. I think this will be interesting to a lot of people. If your revenue in a taxable period is less than 3 million dirhams, you can claim this relief and pay no tax. Uh, this relief is available to both natural and juridical persons. As of now, this relief is only available until 31st of December 2026. If this relief is selected, there's no need to file a full corporate tax return. Rather, a simplified return can be submitted. There are some exclusions though, like a company who is part of a multinational group with consolidated revenue of 3.15 billion dirhams, they cannot avail this relief. Uh, Similarly, non-resident persons and qualifying free zone persons cannot take advantage of this relief. Next slide, please. There are
Can you guys all hear me? I just want to see if Ali's connection is the issue. Okay, thank you very much. I think he's going to reconnect. Just give him one moment, guys. Sorry about that. Sorry, just another moment.
I am so sorry, but my laptop decided to restart in the middle of the webinar.
Oh dear, that's okay. You're back online. We can hear you, Ali.
Okay, thank you. We'll just restart from here. Okay, overview of the UAE corporate tax return. There are different people who can file the corporate tax return of a company. The taxable persons themselves can file, tax agent or legal representative of the company can file, and in case of a tax group, parent company would need to file it. Tax return is required to be filed online by Imara Tax Portal, and the related corporate tax needs to be paid within 9 months after the end of the tax year. It is important to note here that not all fields and schedules need to be filed by every taxable person. Rather, the portal will open up the relevant schedules based on the answers given to different questions. Next slide, please. Okay. So on the screen, you can see the different schedules that need to be filed along with the corporate tax return. There are around 20. From our experience in various surveys, it takes around 27 to 30 hours to gather all the information and complete the full corporate tax return. So I recommend not leaving it for closer to the deadline, but rather start on this much, much earlier. Next slide, please. Okay, what kind of financial statements do companies need and what are the thresholds for audit? If you are a free zone person and want to avail the 0% regime, then you need to prepare audited financial statements as per IFRS, irrespective of any revenue threshold. If you are a taxable person who derives revenue of less than 50 million dirhams, then audit is not mandatory for you. However, you still need to prepare accounts either as per IFRS or IFRS for SMEs. Uh, if you are a taxable person who derives revenue of more than 50 million dirhams, then you need to prepare audited financial statements as per IFRS. For tax groups, if their consolidated revenue is more than 50 million dirhams, then they need to prepare consolidated audited financial statements, and those should be as per IFRS. For taxable persons who avail small business relief, they can prepare accounts either by following IFRS or IFRS for SMEs. They also have the option to prepare accounts on cash basis. For exempt persons, there's no separate requirements. However, they do need to prepare accounts. Next slide, please. Okay. There are various penalties in the corporate tax regime, and taxpayers who fail to abide by the regulations or fulfill their obligations will be subject to these penalties. For example, late registration carries a penalty of 10,000 dirhams. If you fail to submit corporate tax return on time, a monthly penalty of 500 dirhams per month will be imposed for the first 12 months, and then 1,000 per month from 13th month onwards. If you fail to settle corporate tax payment before the deadline, then a separate 14% annual penalty will be applicable. This will be applied per month on unsettled tax amount. As we saw in the VAT regime, penalties are quite high under corporate tax regime as well. So please ensure you take care of all your corporate tax related obligations. Next slide, please. Okay, some key upcoming due dates. Uh, Corporate tax return filing due date is 9 months after the end of financial year. So if your financial year is June to May, then you need to file corporate tax return by the end of this month. Similarly, for people who have a Jan to December financial year, they need to file corporate tax return before 30th September 2025. At this stage, a lot of companies have already registered for corporate tax. However, care should be taken so that all documents in the portal are updated on a regular basis. For example, renewed trade license, renewed Emirates ID, passport of the manager. If any of these documents expire, they need to be updated within 20 days or the company would be penalized. Currently, FTA has given companies an amnesty until 31st of March 2025, whereby previously expired documents can be submitted without the imposition of penalties. So please log into your portals and update your documents. If you're not sure how to do that, reach out to us and we'll assist you. Tax year for national persons is the calendar year. They don't have any separate financial year. So it's a calendar year and you have until 30th September 2025 to file and pay the corporate tax. Uh, for newly formed companies, they must register for corporate tax within 3 months of incorporation. Uh, if a group of companies wants to create a tax group, they must do so before the end of their tax year. So if they weren't able to file it before the end of the tax year, they couldn't file it in that year, and they would have to do it in the next tax year. Uh, if a company is closing down for any reason, they must deregister from corporate tax within 3 months of ceasing operations. Okay, so we are seeing cases where companies are going for liquidation or going for closure, but they have not registered for corporate tax. In this case, they'll have to register for corporate tax, file the relevant corporate tax return, and then deregister for corporate tax because the company won't be properly closed or even the liquidator report won't be issued unless you have satisfied all these conditions. Next slide, please. There are various challenges that companies are facing. The biggest one among them is the transfer pricing compliance. Companies have transactions with related parties, but they do not have any documentation to support the arm's length basis of their transactions. Uh, Similarly, companies do not have proper documentation to support their deductions, and they are not clear about which expenses are deductible and which are not deductible. You must have proper record of all your transactions, and as per corporate tax law, you need to retain those records for at least 7 years. This differs from VAT law, where records are required to be maintained for 5 years. So, corporate tax return filing is a self-assessment process, and FTA can audit the company at any time to ensure the file return is accurate and all supporting documents are available. Next slide, please. Some common mistakes to avoid. Uh, Failure to register on time. At this stage, most of the companies are getting penalties for not registering on time. Yes, there is a reconsideration process in place, but I can assure you that if it is your mistake for not registering on time, FTA will not waive off the penalty. They will only waive off the penalty if FTA is at fault. For example, you applied on time, but for some reason the application got delayed due to maybe portal error, etc. The biggest challenge for free zone companies would be to assess if they are a qualifying free zone person or not. A proper and detailed assessment is needed to check that you satisfy all conditions of a qualifying free zone person. Uh, Similarly, if you fail to disclose your related or connected person transactions, you will be penalized. Okay, that brings us to the end of our presentation. If you have any questions, please feel free to use the chat box and
Yeah.
I'll address them.
We actually do have some already, so I'm just going to read them out to you, Ali, and then
Okay.
hopefully we can assist. So Deepali was asking about, can you please re-explain the deduction expenses for irrecoverable VAT again?
Okay. So if you have from VAT regulations, if you earn income that's exempt from VAT, you cannot claim the related input VAT. Okay. But that same input VAT can be claimed for corporate tax. It's a deductible expense for corporate tax. Or let's say that you received an invoice from one of your suppliers and it was not compliant with the tax invoice requirements, you cannot claim that VAT. But at the same time, that would be a deductible expense for corporate tax.
Muhammad was asking, is it mandatory for all companies to register for corporate tax?
Yes, so all companies incorporated within UAE, they need to register for corporate tax unless they have specific exemption from the government. Like I mentioned, government entities, government controlled entities, qualifying public benefit entities, they don't need to register. But apart from that, all companies must register.
Okay, Zone asked a little bit of a long one, so bear with me. During the discussion, I heard that a foreign company, even if operated from a qualifying free zone, cannot register for a 0% tax liability. Can you please explain a registered branch of a foreign company can be of 0% provided that the other requirements are also met?
Okay,
Did
so
you, yeah,
this
sorry, did you
was,
get that?
yeah. So this is more my explanation was more relevant to a foreign company who do not have a branch in UAE, but they have a permanent establishment or they have a nexus in UAE, uh, or they are being managed or controlled from UAE. In this case, they won't be able to avail the 0% regime. But if you have a branch in UAE and you satisfy all the other conditions, then you can claim the 0% regime.
Okay, there was a second part to that question as well. If that qualifying free zone company makes revenue out of sale proceeds from the qualifying free zone to mainland and export,
Mhm.
um, where, sorry, to export, sorry, I've lost my train of thought. If a qualifying free zone company makes revenue out of sale proceeds from qualifying free zone to mainland in the UAE and export
Mhm.
from qualifying free zone and third port shipment where revenue is recognized inside. Zone, maybe this one is better to take offline because it's obviously quite specific. So I'll get Ali to reach
Okay.
out to you after this, to
Okay.
kind of dive a little bit deeper into that.
Yep.
Um, Deepali actually asked another question about what kind of documents are required for transfer pricing compliance.
Okay. Uh, First of all, you need to have a transfer pricing study in place that specifies that what are the rates you are going to charge. It is done after a lot of market analysis and benchmarking. So you have a basis of the tax authority, they are concerned with why are you charging this rate to your related party? And then you need to demonstrate that, okay, we carried out this study and as per the market conditions, this is the rate that is acceptable. And they are going to demand the transfer pricing study if they come for audit.
Okay, Alicia was asking about transfer pricing documentations as well. Is there a
Yep.
deadline for submission or to be prepared before the annual CIT deadline?
Okay. I have given the answer about documentation in the previous question, but for the deadlines, as I mentioned, there are various thresholds. If you meet those thresholds, you have to submit them with the corporate tax return. If you don't meet the thresholds, you have to maintain the documents. They'll be required to be submitted when the audit comes, when FTA audits the company.
Okay. Um, Ferreira was also asking about transfer pricing documentation. Is there a template or format for that documentation? And is there any other insights you can share on what the how to do an arm's length evaluation?
Okay, so about the details, the related party schedule and the connected person schedule can be found in the tax return. They'll ask you different questions about who the related parties are, what are the transactions, what are the amounts. You have to declare all those. Uh, for transfer pricing, other documentation like local and master file, I'm afraid there isn't a set template. It will have to be a proper transfer pricing study before a local and master file can be prepared. And it would be different for every company, depending on what your transactions are with your related parties or connected persons.
Okay,
Yep.
Lucas was asking about an Abu Dhabi freelance mainland. So he was talking about being a freelancer, I suppose, and his
Yep.
earnings. Is it mandatory for him to register for corporate tax?
Okay. So if you have a freelance license, then you'll be considered a natural person. Okay. And for natural persons, you'll be required to register only if your uh, revenue from this activity is in excess of 1 million dirhams. Below that, you don't need to register.
Okay, so yeah, because he was asking if it was related to his earnings, but it's related to the. Oh no, that would
Yeah,
make
it
sense. Yeah.
it is related to his earnings. So for
Okay.
employment income, no threshold. For personal investment income, no threshold. For income from business activities for which you require a license, for example, he's providing consulting services to another company, then you need to consider that for the threshold of 1 million dirhams.
Lucas, I see that you have a couple of extra questions about how this relates to ADNOC and stuff like that. So again, maybe that's something that Ali can discuss with you offline.
Mhm.
We'll reach out to you separately. And then Marianne was also asking about templates for on how to file corporate tax returns. Is there templates similar to the transfer pricing question?
Okay, so there is a detailed guide issued by the Ministry of Finance which contains all the details of the corporate tax return. You can check that out. And if you go into your portal and start your corporate tax return, it's an interactive return. So as long as you answer the questions, new questions and new sections will keep on appearing. So you can have a look at that.
Okay. Nicholas was asking about, is it mandatory to register for VAT? For example, if all services are provided to overseas clients.
Okay. Uh, So it depends what kind of services. If it is services or goods, I'm assuming yours are services. If you are providing services to clients outside UAE, those are zero rated, but still they are considered taxable transactions. So if your revenue reaches 375,000 dirhams, then yes, you need to register for VAT and you need to file quarterly VAT returns. But you don't need to charge any VAT on these transactions even after you have registered because this is a zero rated transaction.
Um, Rachel was asking a question a bit about this. I'm assuming she for the simple corporate tax return. So I'm
Mhm.
assuming maybe she is a applying potentially for the small
Small business relief, yes.
small business
Yep,
relief. Rachel, let us
yep.
know if that's the case, and then we can let you know a little bit more about the kind of process and what is required on a smaller corporate tax return in terms of what cost that might be associated to you. Um, sorry, Rihanna, I hope I'm saying your name correctly. How about amortizations or depreciations from intangible assets? Are they allowable deductions?
They are allowed deductions as long as they comply with IFRS. Uh, in other countries, the tax office issues different tax depreciation rates, but in UAE currently they have not issued any separate rates. So if your depreciation or amortization is as per IFRS, then that's completely allowed.
Okay. And then Mark's got a question here about whether how is the UAE also introducing capital gains tax on sales and assets of UAE businesses?
Uh, okay, so capital gains tax is here as part of the corporate tax, but it again depends on if you are getting gains from your local holdings or can you claim the participation exemption. If you can claim the participation exemption, then there's no tax on that.
Okay, I think we've made it through all the questions. Let me know if I've missed one of yours. Oh, there we go. Zone has another one. Is there any threshold set for the management salary, or do we have any handy benchmark?
Okay, so this is a tricky one. Because the management or the directors would be considered connected person and they must satisfy the transfer pricing regulations. As of now, there's no specific benchmark. You'll have to keep your supporting documents like different salary surveys that come out every year in UAE. You need to have some basis. Even if you are going with a formal transfer pricing study, uh, those will just be estimates specifically for the management salaries because this is very subjective. Uh, yeah.
Okay. I think that's all the questions then. So if anybody has any additional questions, feel free to reach out to myself or Ali, and we can kind of have a conversation with you separately. But we hope that you found this session to be informative. And yeah, enjoy the rest of your days. Ali, thank you very
All right.
much.
Thank you very much, everyone.
Thank
Bye.
you.